So, hello everybody, online and here in person. I see some new faces and some faces that we already know, but for the newcomers, I will say a few things for us. We are the Global Value Investing Club. Um, we operate in several places, but our main event is here in London. We also do some events in Malta, in other places. In total, we have 7,000 members. You can go to cityfalcon/meetup, cityfalcon.com/meetup, and check about the past events, see all the presentations, and also the performance of the stocks that people previously presented. Um, Online, we have sound, everything is fine. Yeah? Okay. So, today, I don't know, who of you consider yourself a value investor? Some of you. Okay, how do we define value investment? Because today we will present a few stocks that they are not the very typical value examples. For example, they don't trade with a low P or with low multiples. So for you, according to that, are those stocks um, compatible with a value investing philosophy? What do you think? Like different ideas. How are you thinking of value investing? And if you think that growth is part of value, what's your definition? And what do you think about it? Any thoughts? Like, feel free to talk because we'll have a small discussion. Then we will go to the interesting part, which is the presentations. I will just come to you with this one so people online can listen to you.
So there is no real one answer here because value investing has many different definitions. Fundamentally, when you really look at the academic literature, like down to brass tacks, it was defined by Fama and French in Article 992 when they said companies with low book-to-market ratio or low PE are what you consider value investing. That was kind of the original thesis. However, over time, people started looking things at relative value in the sector and so forth and so forth, and start looking at more like economic correlation of certain stocks with economic conditions and so on, and determining those things are valued and these things are not. The whole definition kind of expanded. So there is no one proper definite definition of value. I think it's gonna change in the future, and it's from what it is now, and it has definitely changed from the moment it was invented.
Good. Any other opinion? Okay, Alex. I know you're a hardcore value investor. Probably you don't like the growth.
So for me, value investment.
You can get both of you just
Right. So for me, value investment is looking at financials now and in the past more than really relying on future growth rates because, I mean, some of the values I see, it just can't be a value investment even though there's high growth potential. I mean, if revenue's not that high, if profits aren't that high, if there's not much book value, then to me that cannot be your typical value investment. That's a speculative growth investment, and with that kind of investment, you're relying on the future growth meeting your expectations, and if it doesn't, then you're going to make a heavy loss. Whereas if you buy something that's trading at a third of book, or you know if it has lots of cash, to me that's more of a value investment. So it's more sticking to the financial statements and the fundamentals rather than this kind of optimistic projection of the future. So that's just my definition. It may not be the definition, but it's just.
I mean, I can relate with both, and like I think I'm in the middle. In what sense? I can explain my opinion like quickly. So I think that what is really value investing is the philosophy of it, which is that we are trying to buy something that it's for less than it's worth. And I think that because most of the times this is something that is priced low to some other metrics, that's why people that they follow like value investors, they show like some academics, they show this and they say that's value investing. But I think the philosophy of value investing contains that. Now I can relate also with Alex and say that it's difficult to go to growth and be right. But I am in the middle. I think also that is growth is a significant part of, of value. And if you don't overdo it, it can bring value. But personally, because I find it a difficult task, that's why I'm closer to buying low book. But I can understand the other camp, and I think in a general term. So I lately wrote an article on City Falcon's blog, and I discussed about that, about the three pillars of value, and you can go and read, and also let comments there, or on our meetup page, or on our group, or under the video of this discussion, or on YouTube. You can continue the discussion. Like we want your opinion about what you think. I wrote a few things about how I perceive value, right? I won't say more right now. I'll just quickly show you a new feature that we have. You know about the sentiment. It's something that we have, and it's something I think that you like it as a concept. So I'll just do a live demo here. So basically, we have created a page where you can have all the different types of topics, right? And I think that for you, that you are most of you stock investors, something that it's interesting is that you can see, for example, per day, per week, per month, the stocks that they are they have the most positive sentiment or the most negative sentiment. So you can probably see opportunities, possible opportunities. So for example, here, if we go to Meta Platforms and you are an owner of the stock, or you have invested, you know that this is going on, and here you can see why the sentiment is negative. You see here the Signature Bank or ExxonMobil. And by clicking on the chart, you can see how the sentiment evolves for each period. It's a very quick demonstration, and you can do the same for commodities and all other topic classes. So now we can start the presentation, and we will start with Mikel Bastida, who will present XPEL. Is it XPEL then? XPEL, the right name. Just, Mikel, give me a second.
Appears expensive and people are talking about price to book. Haven't top crowd.
Put it like that in your.
That's okay.
It has some.
Okay.
From this side. Then you can put it here or hold it, whatever you prefer. You are just give me a second.
Yep. Well, so I'm going to introduce.
Okay, check now. Does it work? Put right or left?
Yeah. I'm going to introduce myself quickly. I'm Mikel Bastida. Okay. Okay. No, I'm a.
Let's say Mikel is a regular to our events, and he has presented again. And what I like is like how he analyzes companies. So if I was an investor that invests in more growth stocks, I think adapt a lot from his style. And you can say the rest, but you can follow him here.
Yeah, I can. I don't write much, but maybe one day I will. So what the company that I'm bringing is. Yeah. The company I'm going to be presenting is XPEL. It is a company listed in the Nasdaq in the United States. So XPEL is a manufacturer and distributor of paint protection film for the rest of the presentation, we'll call it PPF. And it's based in Texas. This is a company that it used to be a small cap, has gotten quite big. It's now 1.8 billion market cap. It's doing 324 millions of revenue last year. So you can see the valuation is a little bit high. And this company is 25% owned by insiders, and its analyst coverage is quite small. It's only 3 analysts that usually analyze very small companies. So I'm going to focus the presentation in the competitive advantages of this company, because the first thing that you will notice about this company is it doesn't screen well. You'll see this company is in the automotive aftermarket, which is considered to be a very cyclical business. It has a 40 times PE ratio, looking at last year's earnings. And the shares have done 44-fold in the past 5 years. You can see this, and you may think that this must be some company that produces one product that people got bored in COVID and started to buy non-stop. So I think there are some misconceptions about this company. So this is what I want to explain in this presentation. So first of all, I don't know if you're familiar with the concept of paint protection film. So paint protection film is something that started in the military, and they started to cover some of their vehicles with a paint, with a layer of film that is made of polyurethane. It's made of a plastic, and this allows to protect the military hardware from some light scratches and some debris. This is very valuable for the military because they can protect their hardware, and eventually, if this gets damaged, they remove and they put another layer. So some people started to put this into cars, into vehicles, and it takes a lot of labor. It takes one full car will take like around 2 days to be completely wrapped in this film. What happened is that initially the company that was doing this was 3M, was a giant company, large cap. They were doing this, and this PPF got yellow over time due to the UV exposure. And this, of course, looked very ugly, and there was no market. Nobody would put this on their car if it would start to yellow. The innovation that made this industry happen for vehicles is that XPEL was able to have a breakthrough and produce a paint protection film that had an additional coat, and this, on one hand, made that this layer that after it's finished, it should be invisible to the eye that is installed. This would no longer get yellow. They gave a 10-year warranty for it, and it has self-healing properties. So as you can see here, the light scratches and then some debris that hits the car. Instead of removing material from this layer, what it does is it deforms the material, and then with the application of heat, which could be with a heat gun or even a boiler, a kettle, is some very hot water, it heals the layer, and then it looks like new again. So it's like these scratches, you just put heat, and they go away. And after they were able to develop this, the company sales boomed. So I'm going to go very fast from the history of the company. The company starts, so when only the 3M film exists, the company starts as a software company. And this software company offers a way to cut the 3M film in a cut machine according to the part. So they had a database of patterns for different cars. And this is what all the company was doing. And then Ryan Pape, which is the current CEO, was an employee in the company. In 2008, they almost went bankrupt during the great financial crisis. And then this Ryan Pape left the company, and then a couple of months later, he's asked again, do you want to come to this company? It's nearly bankrupt. You were very passionate about it. And then he takes the role of CEO. He has explained in some interviews that he had to pay expenses of the company with his own credit card. So that was so bad the situation. Of course, we are in the UK, but in the US, this is a very strong, they like these stories of entrepreneurs that save the companies. I'm a little bit more cynical, but this is what he said in interviews, and state of the company was really bad. And his idea was that this film that gets yellow, this will not work. They must do their own. There has to be a breakthrough. There has to be a film that really will appeal to consumers, that they will want to put it on the cars. And that's why they were able to achieve this, and they were able to produce their own PPF. And after this, like, the sales boom. So it went from a software company to a company which primarily sold this paint protection film, and then the software was just something else. Then the sales went up. And in 2016, 3M comes and files a lawsuit against them for patent infringement, because they were the ones that produced that in the first place. So again, for the second time, the company almost went to zero. They were fighting this. They were distracted. In 2017, it turns out they were able to settle this without affecting the company. And after this, they could concentrate again on the growth of the company. And after that, they expanded to different areas. Now they started to put film in Windows. They started to expand internationally, and then eventually they listed on the Nasdaq, and then the growth has accelerated a lot since 2020. A lot of people in Canada bought in the 3M XPEL lawsuit time and have gotten 100 baggers, so it's pretty popular in Twitter. Some people are rich because of this, not me. But I still bought it in around 2020, I believe. So this is what the company did. So at the beginning, it was a software company. Then as soon as they started to not be a software company and sell product, then the gross margin of the company started to go down. And this also coincided with the 3M lawsuit. So at one point, people were completely skeptical. Like, this company is going to zero. It's being sued by a giant. The margins are going down and down. Like, this is a complete disaster. And then eventually, the margins of the product starts to go up. And this is the story and why it has been a complete turnaround for them. So what's for the consumer who wants to put PPF on the car? So the PPF has the functional part that it protects the car. It looks very pretty. I'm not a car person. I don't own a car, but I see this, and the cars look very well. You can put also a type of film that will make the car matte finish. They offer 10-year warranty. XPEL is the leader in this segment. They created the industry. So there is both an aesthetic and a functional part for someone to install it. If someone will want to install it, they work to an installer who will install it professionally, because this takes a lot of time. And the installer, let's give an example. It will charge around $6,000 for protecting the full car, so full body wrap. And this will be around $6,000 cost from the installer. It will incur in a lot of man hours that will be dedicated to this. They also need equipment. They need the cut machine. There's also a very small part for the software that has the cut patterns for different vehicles. And then let's say around $1,000, a little bit more, for the XPEL PPF. So the PPF comes in rolls, and they put it in the machine. The reason why you want to use the software is, first, it saves time. And second, then you cut it to the size, because if this very, very expensive wrap, you cut it in the wrong size, then you are wasting a lot of material. So what I want to say in this slide mainly is that the XPEL, so this is a huge job for the installer, but the XPEL products constitute around 20–25% of the total cost. If they decided to charge more for a more luxurious car, the margin for the installer will be even larger. And this generates an industry in that the XPEL is selling to the installer, but XPEL is advertising towards the end customer. This would be a B2B2C type of company. There's another person that owns this before me, so has done more returns than me, and he compared this model like to the one of this Invisalign retainer for your teeth. That there's a lot of word of mouth, and you say, "Oh, how did you fix your teeth?" "Oh, I fixed them with Invisalign." Here will be like this. So people install XPEL on their car, and it's like, "Oh, what did you do?" I put XPEL in my car, but actually, it's the installers who are the customer. And then this gives XPEL a lot of pricing powers to with the installer. They can hike the prices, and they have done this in the past. So this contributes towards increasing their gross margins. And since this is not a big part of the total cost, they are able to do that. And that's why I made this analogy. There's a lot of incentive for an installer to use XPEL exclusively instead of another competitor which is cheaper. First of all, the software from XPEL has the biggest database. So if a rare car comes to you to get this, you don't want to say, oh, I cannot do this because it's not on my database. You get discounts if you're using the software. So this software product thing complement very well. If you put a lower quality film, you will save some dollars on the whole job, but you may have quality issues. They could have even reputational damage to the installer. And you are approaching very high-end customers who want to make the full wrap. If you say you don't have XPEL, then the consumer may pass on the job and go to another one. XPEL offers training, assistance for the installers. They have a very good relationship. This is for XPEL very important. And then the software is being more and more used for other administrative tasks. So it's now kind of like the operating. They want to be like the operating system. They also want to help with scheduling, other things that the installer has to do that is not working on cars to make it easier. So they want to add more value. And this generates, in my opinion, a company that, even though it doesn't advertise like this, for me, XPEL is kind of like a franchisor, because first, like, it distributes this product in different geographies to distributors. They have distributor in Europe, in North America, Canada. They consider the dealer as the ambassador of the product. They only select some dealers that will carry XPEL film wrap after meeting some requirements. They have their own stores to experiment with the product and have some more feedback from customers. There is a lot of brand awareness in the consumer. An installer can differentiate himself with XPEL. They can put XPEL, so the XPEL branding everywhere. They also issue marketing and SEO guidelines for the installers. So you wouldn't think like your car repair shop as someone who has a cool Instagram and is trying to differentiate itself like that. But they are putting a lot of emphasis on doing marketing. And this for the company very important, because they think that it's not only the quality, it's also that there is not awareness enough. Like, they think that there will be more customers if they found out about this that would be interested in the brain protection film. And ultimately, the XPEL website is used to generate lists. The same like, I know you look where is a Starbucks restaurant, maybe you look on the Starbucks website. Here you go to the XPEL website, where is an installer of XPEL. And by that, you generate leads. And this is very good because it can create, it can land people jobs that are $6,000, $7,000 worth of installing wrap. Some more unique characteristics that I think makes this company special is that, for example, the insurance pays for the PPFs. Let's say you put PPF on your car and you have an accident, a third party damages your car. The insurance is going to pay to reinstate the XPEL PPF, while you don't bear the cost. So this is usually very good. Also lands more jobs for the installers, so they are also very happy about this. They will want you to have accidents that don't damage your life, but damage your car. I think the value proposition of protecting your car could also make sense for lower value cars, that they will want to protect the front, for example. And the car will be more protected. It will have better resale value if it's a lower quality car that you want to sell in the future. The historical library that they have of database of patents for different cars is very important. And there seems to be a very high penetration in electric vehicles, especially Tesla. I believe that people who buy electric vehicles feel like this is like the forever vehicle. This is not a vehicle that they're going to trade and change in 2-3 years. So there is a more inclination to protect electric vehicles. That's why this is the market that they are having more sales. They're also having more sales in parts of the of the world where the cars damage more just because of the geography. There's a lot of rocks in the road. So the management, as I said, is 25% insider ownership. So they own combined 450 million. So that's quite a lot of net worth. They are very incentivized to get rewarded by their appreciation of the shares. Ryan Pape has been the CEO since the company was almost a zero. They created a leader of an industry that didn't exist. So I have to say, even though I will not give them lessons of what they have to do in the future and how they have to optimize, because they seem to be very competent. So they have good track records, so I have to recognize that. The CEO, whenever he speaks out about the capital allocation, and for him, it's very important to have a very capital-light model. That's why, for example, the manufacturing is outsourced, and now more it has been outsourced to different suppliers, so none of them has a lot of control over the company. And unlike other growth companies, this company almost doesn't give stock-based compensation. The share count has been pretty stable since the revenue was like around 3-4 million, and now the revenue is 300 and something. So have to recognize that they did all of this without diluting the shareholders, which is also very good. The company doesn't have a lot of debt, so it's also very good. So mostly why I like this company is because I think this company can still grow. Yeah, it's in a price to book value more than one, unfortunately for some. But for me, it's very important that I see many areas in which it can grow. So the company is, so the PPF and the window protection film, which is now the two main products that they sell, they are still growing. There's an opportunity to wrap non-luxury cars. There's an opportunity to put this in other vehicles. So there are a lot of cases when you ask the installers is that people are bringing things that are not cars, like, oh, I like this on my car. Can you put this on my yacht? Or can I put this on my, I don't know, motorbike? Can I put this on my, for example, there was a company that was taking XPEL wrap and putting it on bicycles. It was called Enphase Frame, a company based in the UK. It was acquired by XPEL ultimately because they see this also as an area of growth. And then they're also using the software as a business management for the installers. And other thing that the company has started to do is that they started to acquire some installers of film. Previously, they were not doing that. So the company is trading at 30 times EBITDA and 5.5 revenue. They are buying installers at 5 times EBITDA and 1.2 times sales. And this is bringing margins in line with the company. So you can imagine as soon as they buy these companies, they are accretive to revenue and to earnings because they immediately re-rate. Yeah. Okay, don't worry. I'm going towards them. Yeah, so this is super interesting because if you think about it, like an installer of XPEL film, it has no natural buyer. No one, you are not going to have private equity to buy an installer of XPEL. That would make no sense. This is a very low scale. So the most obvious buyer is like either this is a generational business that you give to your children or to someone super competent. Or what some companies are doing is they are selling their business back to XPEL. And that's why XPEL is acquiring some companies, and this is providing a very good avenue of inorganic growth. And they want to use these installers. Some of them are high volume installers in order to some of the areas of growth that they identify. One of them is, so they want to install the PPF themselves for vehicle manufacturers, and they want to do it also for car dealers. And for example, Rivian cars in the US, in the configurator, you already have the option to put XPEL, flame protection film. There is also a risk, of course, the vehicle manufacturer, they could manufacture their own PPF and then bypass XPEL completely. But it's very interesting that they are choosing to go with XPEL instead of doing that because they see that XPEL has this reputation, and then if this gets damaged, then this can be repaired by XPEL. And then here I wanted to show that even in the most mature markets would be US and Canada, it seems to be, they seem to be growing. And if you see like, if the other developed markets would start to follow the trajectory of Canada and the US, then there are indications that there should be enough growth in this company if North America looks at as an example. They are both growing organically in their own products and then organically by doing some acquisitions. Also, penetration in electric vehicles is high, more electric vehicles being sold. So just wanted to say why the share price went from 80 to 60 last month. Is the company is the distributor of the product, except for the case in China. And the company started to have very high inventory levels on purpose in order to be able to manage the growth because they saw the supply issues that they were in 2020, 2021. But China, they work with a third party as a distributor, and they canceled a very big order because they had a lot of inventory that they had collected between 2020 and 2022. Because of the supply chain issues, they had a very high inventory. They asked that they wanted to burn through the inventory instead of buying more PPF. They canceled the order, so that's why the revenue went down, and that's why the share went down. But as you can see, the other geographies are growing very well. So yeah, I want to say this is a company that you look how it is now, I think is quite fairly valued considering the growth. So the whole idea in this company is, given these characteristics, like, do you believe this company should be valued at a premium or not? Because I'm putting there's opportunity for inorganic growth. They are rolling up businesses at lower multiples, and they are re-rating at XPEL multiple. The company has managed growth extremely well, has very competent management. It has overcome inflation really well. The margins went up, not down last year, and they are doing product, they are doing labor. They haven't diluted. They didn't do expensive acquisitions in 2021 like other growth companies. They did acquisitions, but they did them at very good multiples. The company is very good in capital allocations. It was able to overcome the supply chain issues that other companies had. And the underlying market, like in 2021, the car sales went down, and this company sales went up as they never did in other part of the history. So I think it's super impressive what they're done. And I think this is an extraordinary company that deserves a high multiple. I don't know, maybe you agree or you disagree, but I hope you like the presentations. There are some risks, but this is XPEL. I feel it's a little bit misunderstood company. It has very low analyst coverage. Until very recently, it was a small cap, so it doesn't have a lot of funds owning it. They were not able to own it because of the size. So yeah, it's a little. There's some Twitter accounts following it, but otherwise it's a little bit underfollowed even now. Yeah. So I put a risk like the China is distributed by a third party. 10% of sales are to China, if you consider that a geopolitical risk. The manufacturing is outsourced, but now they have diversified their suppliers, so that should be good. They actually cut the contract that they have with their main supplier. We believe that they cut the contract in order to negotiate a better price because the margins went in the good direction after that, and they were more diversified and they could get this product from other suppliers. You could say commoditized product and software. Technically, yes, but whenever a brand is so strong, there is an incentive to continue using the brand at a premium.
Presentation is fine. You can check more. We can take for now 1, 2 questions, and later.
Yeah, you can discuss with me.
Yeah, more questions, and of course, discussions.
Yeah. You can discuss with me later if you want to.
Question. Yeah.
Yes. Maybe you already mentioned and I missed. But how much cash do they have on the books? Like how much cash are they holding? Because it's a profitable company. Do you know?
So they have now a little bit of debt. It's not much. I think the interest payments is no, but no. No, they have very few debt. It's on the assets. It, it's net debt. I think the interest payments is around 3 or 4% of the EBITDA. So it's not very much. Yep. No. So the company has had bad working capital as they were growing the inventories on purpose to manage the growth. Now they have said that this is going to end because this has ended because there is no more supply chain risk and it has normalized. So the working capital should add to artificial free cash flow in the coming quarters. 10 million net debt in 1 billion market. Yes.
That's much bigger than what. Oh, yes, it's a market cap equals EV.
Yeah.
Another question? Any other question?
So my question is, from what you just said, it seems that the company's reason of existence is the IP, and yeah. So why are they acquiring installers? It seems like a bit of a dilutive acquisition. It's going down the value chain. It seems acquiring businesses which actually have very little value to the product. And I presume also that there's literally like 1,000 or 1,000,000 installers that actually use the product. So if they acquire 2 or 3 or 4 or 10, it still be a very fractional part of the whole equation.
So one of the acquisition was the company that was putting XPEL into bicycles. So that's added value. Another company was super big in window protection, and they want to use this. They want to use this to install for car dealers and for vehicle manufacturers. One of them that they bought is a high volume acquisition. The gross margins of these installers are higher, but it has also more SG&A, so it kind of wash up. But it's not dilutive to margin so far. But I didn't add the financials of the acquisition because then the presentation will be 1 hour. You can analyze one by one. But it's also a thesis that you have to trust the management, because people distrusted the management, and the management has so far has beaten their own guidance each time until the last quarter because of the China order cancellation.
And let me read. So that's it. Please, stage is yours. Okay. You can hold this, or you can put it somewhere like here, like you can have it, or you can hold it, or you can have it like in your pocket, or put it like that. Okay. And
What do I do? Just press.
no, this is for the sound. That's why I told you, if you can have it like in your pocket or somewhere like that, we can put it. Okay, fantastic. We can put it like that. And this one, I can make it.
Sorry, I'm not very good with technology.
And
Okay.
this one you can try work. left and right, left and right.
Okay.
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 So with us we have Sanjiv, Sanjiv, right?
Yes, yes, correct. Yeah.
Who works please? He will present Enphase Energy. I like this company because I have a dramatic experience from SolarEdge, which is a similar company. I bought it in 2017. It was a value company. I sold it like as a free for buyer, and I was very happy. In a few months, I got 4 times my money, and then I don't know, well, it went 30 times up, something like that.
We'll see the reasons for that. Yeah.
So yeah.
Okay. Well, thank you very much, Demetrius, for giving me the opportunity. Does anybody know this company at all? Great. I'm not a technical person, so whatever I present, I may have made some elementary errors, for which I apologize. So I thought I'd start. I don't normally start with like a global picture, but I thought in this case it's appropriate. Solar is hot. It's hot. It's grown a hell of a lot, as this chart shows, and it's expected to grow very rapidly, especially in China and India and the Asia Pacific generally. This is from a think tank that specializes in the area, and they think that capacity will go from about 800 gigawatts today to 1600, which roughly is a CAGR of 9% a year. And if you look at, I just did a quick trawl of some countries and what they want to do. And if you add some of the capacity that individual countries and regions say they want to do, then the previous graph is actually an underestimate. So for example, China is talking about 2025, 835 gigawatts. India is coming from a lower base, but growing very fast for reasons we can discuss later. They're talking about 280 gigawatts. Even the European Union it has got some plans, and I will talk later about what the US has done and what they're willing to do. So essentially, for the purpose of this presentation, because I need to go through it quickly, I hope you'll accept that it's a growth industry. This is the data on the US, very, very dramatic growth. And it's been driven by taxes and subsidies and declining costs globally. The way the experts look at different energy sources is they look at something called levelized cost of energy, which includes the capital cost, operation costs, all the total costs. And you can see the orange line, solar, per megawatt hour, which is about 1,000 watts. I mean, in my own house, I use about 7 kilowatts. So it's about 120, 140 houses per megawatt. But you can see the most dramatic decrease there has been in the cost of solar panels. And you can see it in the slightly different way of looking at it, but essentially the cost of renewable energy. This is the marginal cost of producing 1 kilowatt. And you can see solar, concentrating solar, which I hadn't heard of, is apparently when you use mirrors to concentrate the light onto a particular point and generate that way. But if you look at the photovoltaic, which is what I'll be mostly talking about, only onshore wind is a little bit cheaper. But essentially, solar is about 5 US cents a kilowatt. And in India, according to one study, they've got it down to about 3 cents a kilowatt, so 2 pence, something like that. Solar or photovoltaic? No, I don't know anything about that. I have not come across it apart from in this graph. But just to give you an idea, I think today, compared to the 2 cents in India or the 5 cents shown there, today my cost is 31 pence a kilowatt. Of course, it's gone up because of Ukraine and other things which are in the news every day, but it's clearly a different order of magnitude of cost. Okay, so just a small explanation there. The top panel shows the traditional structure of residential solar installation. So you have a whole series of panels The power goes into a DC AC inverter. So the electricity generated by the panel is direct current. It needs to be converted into AC, and then it goes into your house, etc. The problem with this system is relatively cheap and the technology is well established. The problem is if one of the panels is overlooked by shade or an obstruction of some sort. So let's say in this case, the panel on the left, and let's say it's only producing 50% of the energy, the whole system will only produce 50% energy. So just that one obstruction has reduced the output efficiency of the whole system. So a few years ago, Enphase, the company we're going to discuss, invented some particular type of microinverter. So that's shown in the bottom panel there. And here what happens is the microinverter is attached to each panel, and then that converts the direct current into AC, and then it goes into the home in the way that we've shown there. And now the fact that one panel is shaded does not impact on the output of all the other panels. So in my own house, when I fitted this 3 years ago, one particular panel was very badly sited. So my installer said, put some very cheap Chinese solar panels in, but put some Enphase microinverters, and you'll get that result. The middle panel shows the approach taken by the company that Demetrius mentioned, Solar Edge. So they use something called power optimizers, and they go again at the bottom of each panel, or attached to each panel, but they continue to maintain a string inverter for converting from direct current to AC, but essentially the result is the same. So all these slides that I presented, they come from a paper I wrote where I'm actually comparing Enphase and Solar Edge, but I don't have time to go into Solar Edge today. Okay, so these are the basic facts about Enphase. It's a relatively new company, 2006, based in California. Their customers are the installers themselves, homeowners, and module partners. Module partners are companies that either produce the solar panels or buy them from China or Vietnam or wherever they are obtaining them from, and attach the Enphase inverters. Enphase themselves have an installer network of 1,200 installers who they work with. They also sell to utilities, companies, and so on. I've seen different numbers, but this looks to be from the annual report, the most recent 10K. 52 million inverters, microinverters have been shipped, and 17 gigawatts of capacity, and 2.7 million systems in 145 countries. So it's a big scale company. This is what the inverter looks like, and this is IQ7. I thought it was the latest, but they've come up with IQ8. So as we'll see later, their essential core strength is the technology and the development of the technology. And from what they tell me, and I'm not a technical person, they have a system chip on there, which apparently is a source of some advantage over competing products. Not so much Solar Edge, but some other products. So essentially, the company for the first 15 years or so, or first 12 years, was a producer of microinverters. But in the last 3 years, they've changed, as has the industry and as has Solar Edge, to what they call, they're not just providing the microinverters, but a home energy solution, where they're targeting residential users and also energy solutions for commercial purposes. So the home energy solution obviously includes the microinverters, but it also includes batteries, increasingly EV chargers, and then a smart box, which they call the combiner or the IQ Envoy, and software, which means that, for example, I have a software on my phone. I can look, okay, how much power did the system give me today? How much of that did I use? How much of it sent back to the grid, and so on. And it has a very cool feature, which I like, which shows you how many trees you've saved since you installed the system. So this is just another picture of what it looks like. I've got the top unit, the combiner in my garage, and then I've got this on my phone or on my iPad or whatever. Some of this I've already mentioned already, but 2 points to mention. The company claims they have a capex light model. They outsource all their manufacturing, always have done, to 4 or 5 contract manufacturers in the Far East, in Europe, and in Mexico. They work with them. They have long-term relationship with them, and are very mindful of not, using them to cut the price down beyond the point. They manufacture in China, India, and Romania. Romania for the European market. Sorry, it's not on there. Mexico as well. Mexico for the US market, and so on. As part of their move from just being an inverter manufacturer to a home energy solution, they've also lined up 2 contract manufacturers for the battery, which is the highest cost by far when you install a residential solar. The panels are very cheap, all the little bits and software they give you for free, but it's the battery that's very expensive. But more interestingly, I mean, everybody these days, including XPEL, claim to be capex light, but the company also claims their business model is OPEX light. 55% of their headcount, total headcount, is in India. They have a research center in India, but also a lot of the middle management is based in India. And they claim this gives them a big advantage in terms of margins and so on. I said that they'd converted themselves from a simple microinverter manufacturer to a home energy solutions provider. And the microinverter part, they've always kept in-house in terms of doing the R&D and everything. But for the other parts of it, the software and so on, they've done a series of relatively small acquisitions in the last 3 years. And I've listed them there. For example, they've taken over one company, which is DIN Engineering, which is from India, which when the installer goes with his iPad to your house or whatever, he has that software and he puts in a few bits of detail in the machine and it generates the plan for how it would look on your roof. They also have a company which has some software for generating leads and various other companies. Point is, a lot of these acquisitions were relatively small and were always done out of cash. Just a few, I didn't quite know what the format was, so I hope I've not shown too much or too little numbers, but I just wanted to show you a few things. So 10-year revenue, and this one's 10-year net income. So you can see the company is essentially grown from 218 million in 2012 in terms of revenue to over 2 billion, 2.3 billion in the last calendar year. The financial year is a calendar year. And the company has become profitable since 2019 and looks like it's on its way to profitability. I wanted to just show you the similar growth, obviously, in the balance sheet. And I'm showing you the total assets and also the current assets. So a very large part of their balance sheet is made up of current assets. And another way of looking at the same thing is to show that their property, plant, equipment is relatively small part of their balance sheet. And this validates what I said, that they had a capex like model. The company became positive in operating cash flow in 2019, and as you can see, as they've expanded their output, the amount of cash they've started to generate has become quite significant. So, for example, December 22, you can see about 758 million out of total turnover of 2.3 billion. Quite significant free cash flow margin. Sorry, that was operating cash flow. And here a chart to show that a very large part of that operating cash flow is converted into free cash flow, just showing that very little capex they need to do relative to the cash they're generating. Apologies if you can't see this. I tried to make the text bigger, but essentially it just shows the ROE, return on equity. Currently is about 34%. Gross profit margin of 40, and pre-tax is high single digits. And some other data which you can easily look up. Two themes seem to be very current at the moment relating to this industry and this company. One is the Inflation Reduction Act, which was passed by the Biden administration. It directs about 400 billion of subsidies into clean energy. This is huge, 400 billion. I had to check that twice. I mean, some people say it's 370 billion, but the order of magnitude is correct. In particular, for this company, it allows an income ITC investment tax credit, where residents can deduct 30% of the cost of installing residential solar from federal taxes, and applies to batteries as well. So this might encourage people to retrofit batteries onto existing systems, and obviously anybody who's installing a new system will benefit from this. And the other part of the IRA is AMPTC, and I've forgotten what it stands for, Advanced Manufacturing Production Tax Credit. This is very, very important, getting a lot of people very excited in this industry. For example, for Enphase, it gives 11 cents per watt credit, and all the credits are listed for different products for an inverter. So for a typical 320 watt inverter, it's about $20 to $30 per unit. And since these units sell for about $50, $60 a unit, it's actually quite significant. On the last earnings conference call, the company said they're looking very seriously at moving some production from Mexico into the US. The other factor, which is, I think, currently important, is California. California is a very large part of the solar business in the US. California, Florida, and Texas account for 50% of installed capacity of solar, and California itself accounts for 33%, and it accounts for 20% of Enphase's revenue. They have various local taxes, subsidies, which encourage installation of solar equipment for residents. And I think it was called the net energy metering system, where the utilities pay you a certain FIT tariff for any electricity that you generate. The problem with the original NEM was it was too successful. A lot of people took advantage of it and started generating electricity and started feeding into the system. And the problem was that because the capital cost of these things is still quite high, it tended to be higher income people, and they were not paying anything for the maintenance of the grid. And people who couldn't afford solar systems, their bills had to go up to make up for the cost. And politically, this was seen as very unfortunate. And therefore, they've introduced NEM3, which is significantly reducing the tariff, as you can see, from 25 to 35 cents a kilowatt to 5 or 8 cents. A big reduction. So let's say it's 8 cents, that's about 5 pence a kilowatt, translating into pound, which is roughly what I get today on my solar system in London. For any electricity I don't use and it goes into the grid, they pay me 5 pence. And of course, any electricity I use, they're charging me 31 pence. It's a nice bit of a spread that they're making. But one of the explicit aims of NEM is to encourage people in California, to install batteries. Because if you're exporting a lot of electricity and getting next to nothing for it, you might as well install a battery, store it, and use it in your own house and power your EV and so on. This is another research estimate on California. So they expect it to still carry on, but maybe retrofit will become more important. Yeah, plenty of time. So I've just summarized what I think the strengths of the company are. Enphase is a leading player with a strong position in the US market and a growing position in the rest of the world. And along with Solar Edge, they control a very large percentage of this market. They're taking a lot of market share from other people. And the main competitor technologically is the string inverter, which for reasons we discussed earlier, is obsolete technology for residential. For greenfield commercial sites, inverters still make sense because there you get rid of the problem by choosing a location where there isn't any shading. So then shading is not an issue, and you can put in string inverters. Both SolarEdge and Enphase have a long history of product innovation. SolarEdge is an Israeli company, but listed on the NASDAQ. And both of them are trying to change from producer of inverters or power optimizers in the case of SolarEdge to become a holistic energy system, energy solution supplier. Company has a foothold outside the United States. So a lot of the growth in the rest is going to come from Europe and the rest of the world. And in fact, because of what's happening in California and what's happened in Europe after the invasion of Ukraine, they're seeing much higher growth in Europe in the last couple of quarters, in the last quarter, than they did in US. Germany, France, very strong demand. Company also, as I mentioned, has a capex light and OpEx light model, and we can see some of that evidence in their margins. Weaknesses, well, there are many other players for microinverters, batteries, especially in energy management systems, in particular SolarEdge. Remains to be seen whether they have any significant competitive advantage over the competition. I think they do because of their track record in innovation and the growth that they've managed to generate so far. California is obviously clearly a negative, especially in the short run, because the economics of installing residential solar has changed significantly. But it might encourage people to retrofit batteries. And if you install a battery with your residential solar system, it's still quite good. And obviously, the regulations don't apply to commercial systems. So their sales to utilities and so on might still increase. Opportunity, well, globally, from the charts I showed before, solar power can only grow because of the lower costs, because it's very suitable for many, many countries. EV owners are more likely to install the residential solar systems. So as EVs increase, maybe demand will grow up. And Enphase has a very interesting product which they started using in India, which is a solar water pump, which is aimed at farmers. So you don't, you're running a small farm, you need a water pump, but you don't have any electricity. It's a water pump with its own solar panels in a box. It just sits in the field. You start it up. As long as the sun's shining, your water pump works. And they're working with various NGOs to try and increase demand for this. Competition is likely to intensify, and a lot of the competition, I suspect, is going to come from China, because that's where a lot of the growth is going to come. As an aside on this, in the US, they have much higher regulations about the kind of equipment you can put in. So a lot of the Chinese manufacturers don't really sell in the US. It's very, very different in Europe. So the profitability of their Enphase and SolarEdge's business in Europe is much less than it is in the US. So as Enphase itself expands in Europe, its profitability might go down. And then I apologize for the print here, but anyway, I just tried to do a quick DCF valuation of this company. And obviously, DCF, it's garbage in, garbage out, depending on which assumptions you put in. You can get any number. But I put in various what I consider conservative numbers, and came up with a valuation of $200. This was done on the 13th of the month. At that time, the share price was 210. So I thought, okay, fair values are 200. If it goes to 175, I can look to buy. Yesterday or 2 days ago, it went down in this current crash to 183. Unfortunately, it's come back to nearly 200 in the last 2 days. That's it. Thank you. Oh, no worries. we have our money with them, some client money in Zurich, but that's protected. Yeah, but we had leverage against it, so we're not worried about that, or that part of it anyway. Oh yes, sorry. Sorry.
And this from here. Do you want to start, Ruzbeh?
Yeah, I can start.
If you want to hold those two,
That's
or
fine.
you can put it
That's
in
fine.
your.
Amber, you can. So yeah, I mean, some bonds are exciting. I don't know, with the yield to maturities being quite high. So I've been accumulating a few bonds. There was also on that list of bonds that the platform I was using, there was also Credit Suisse. It still shows the price to be at 100. I don't know how. Those are senior bonds. So, okay, okay. I didn't. Okay. Okay, so not bad. So you're still not affected if had you bought those bonds, senior bonds. No. Okay, good to know. Okay, okay, brilliant. So this is more of a discussion. So I think I'm sure all of us have read a lot about what's going on. Silicon Valley Bank, which is as someone who runs his own company, I actually admire quite a lot in what they've done. So yeah. Okay, that's fine. Yes, it's fine. So Silicon Valley Bank is very popular in California because unlike the traditional banks, they're a little bit more risk taking. So whether it's venture debts, they're more supportive of businesses, which is I think their contribution. So I admire them. So even if they have failed, but they have kind of helped a lot of businesses grow and be successful. So that's a good thing compared to other banks. So a lot of things happened here, right? And again, please chip in as you discuss. So one is the venture market has changed a lot from what it was in 2021 or during COVID, to what it is now. So where you could raise money at really significant valuations, 10 million at a pre-revenue stage, funding, for example. So all of that is dried out, which meant that the companies, the startups, the early stage companies had to have access to more of their capital. They couldn't just leave it in the bank. Because imagine if you raise 10 million, 20 million, 100 million, you may not spend all of that money in the first year. It's probably over 2 years. So you leave all that money in SVB and then you start using it. But now that you don't have more funding, you need access to that capital. And obviously, so the Fed rate increases, which is, even today they increased, which is clearly giving a sign that, they're supporting the consumer, the inflation levels, which I think is the right thing to do. And so the market has suffered, obviously, with that. But it's interesting, and I know you guys work with bonds, but it's like I'm not an expert in bonds. I prefer equity usually, but when I was all throughout, I had some money and I was buying short-term bonds, right? Because I wanted to be able to have maturity, in sight instead of holding really long terms where there's a lot of volatility in the price. It's very strange that a bank like SVB put so much money in long dated bonds and then kind of exit. It's probably maybe a few people that brought the whole bank down. So it wasn't really like let's say like a Lehman Brothers that we saw. So they did most things right except one screw up, and that brought everything down. So yeah, and then I think the thing also that happened was there was this discussion in a lot of the startup journals, which is SVB gave startups a lot of time, like years, to funding their businesses, and the fact that the startups and the early stage companies and the VCs couldn't give them more than 2 hours because of the bank run on SVB, which is what brought everything down. Had that not happened, probably they could have survived, but it was just the panic that went in. And it's a shame that it came. So any thoughts on this, on SVB in general? Anything else?
Oh, so the Twitter tells you there was a call of 200 early stage investors from Silicon Valley. They had a big conference, like a virtual one, and they talk about lots of things. At the end, they started talking about SVB, and then all of them decided to pull money out the very next day, and this is what brought the laying down. So it's kind of like self-inflicted pain by the very community that the bank was serving. It's irony.
Yes, agreed. Agreed, agreed. And I think this is where now that there is some stability, and for example, in the UK, it's bought by HSBC. The VCs and startups are saying we'll put money back in to support the banks to survive. But if you are a shareholder, if you are someone who is running that company management team, you've lost a lot in a very short time. So anyway, so that was Uh, and Dimitris, you want to explain the chart?
Yeah. So part of the problem is that Silicon Valley, most of the deposits were deposits of more than 250,000, which were not covered by the FD, how we call it, yeah, FDIC, yeah. So that brought more panic. So you see other major companies, it's only 40%. It's 40% of their are covered. But for Silicon Valley Bank, it was only 2.7% because they were startups basically. So they were big depositors, only big depositors in. So that's what the graph shows next. And I can talk about this, yeah. So here you can see that the pain that this situation has inflicted for the past year, right? Because okay, they had some pain lately, and this is just to explain to you, this is a graph that shows an ETF that follows the S&P 500, and then an ETF that covers the regional banks, right? And another that covers the financials. So somebody who bought an ETF, which is a diversified vehicle, has lost in a year 40%, which is really painful for an ETF. And you see, like, that if we add what has happened, the situation inflicted a more severe. Yeah. I'm sorry. This is an ETF that covers the regional bank segment. So it's an ETF that follows, so shows what has happened to people that they have invested in regional banks. And it's a proxy that shows that on average in a year they have lost 40%. That's a big decline. And of course, a much bigger decline for Credit Suisse. The problem traveled to the other part of the Atlantic, and you see there that the shareholders lost almost 90%. And this is something that people that they have lived through banking crisis, either from 2008 on, me coming from Greece, that I have seen banks collapsing again and again. People think that, okay, we will save the bank, so probably, but the depositors will almost always get their money, but the shareholders very often lose their money. And something very very strange for Credit Suisse is that with this deal with UBS, there were bond holders that they are losing their money, holders of 81 bonds, that losing their money, while shareholders are are recovering some of their value, which is strange. Does anyone has any opinion on that?
Yeah, this is something I've looked at. And obviously, in normal hierarchy, bonds rank above equity. But 81s or COCOs, there are two types. One is an equity conversion, and one is a write-down. And apparently, a lot of the Swiss banks were write-down rather than equity conversion, whereas all the UK and most of the EU countries have equity conversion. So the European Banking Authority and the Bank of England said, no, they still accept that equity is before debt. But the Swiss chose, in my opinion, wrongly, to wipe out the bondholders. These are all regulatory capital, right? Banks have to have some minimum regulatory capital. They can either have it all as equity, but people thought, no, we'll have some equity, but we'll also have some bonds. Now, with the collapse in the price of these bonds after the confidence is gone, it's going to be very difficult for banks who need to maintain a minimum regulatory capital to issue these bonds. So either they have to do it all by equity, which will be dilutive, or they will have to cut assets, which means in the long run, the implications of this will be contractionary.
Do you think that this might make this change inherent in the deal that will put pressure in the deal will change so the shareholders will lose first their money so it doesn't create this moral hazard?
Yeah, no, I think in Europe and UK, they've said they don't agree with the Swiss, but I think the damage has been done because the COCOs of all the other banks, including the British banks and others, have all fallen to about 12%. So if you want to do a new one, you have to pay premium over that, let's say 13%. You say, why should I do that? I might as well get equity or not do it at all.
Thank you. Okay, we first is you, and then I'm coming to you, okay?
So there's very one important point that you have to note with Credit Suisse. A lot of the shareholder list, some say up to 37%, was held by sovereign states, not shareholders, countries. And Qatar, yes. They say that there was actually more. Yeah. So the moment it's very easy to wipe out shareholders as a sovereign, because Swiss regulators, Swiss government decided to they had a choice between wipe out shareholders or not. It's very easy to do it when you're wiping out shareholders without any affiliation to a sovereign state. When you start wiping out shareholders who are actually affiliated to another state, it becomes political. So for political, diplomatic, whatever you want to call it, reasons, you choose regulation interpretation in such a way to make sure that your geopolitical standing is not impaired too much. And that's it, because they could have done anything, but they chose to do it. And the question is why? And I think that's the answer here.
Yeah, I kind of wanted to say the same. I'm not a professional, but it seems to be like a political thing. From what I understand, they bypassed the shareholder vote, so they just gave like politically this little gift, and they wiped out the 81, which was only institutional investors and sophisticated. So they say, oh, their fault for not reading the thing. So someone commented from Switzerland, someone who works there, that there are also a small, apart from sovereign states, there are also like a small investors, particular investors in Credit Suisse who would be also very upset if the government like wiped their things to zero. So getting a little bit maybe helps. Save face. Yeah.
Something that I want to add here is that here you see news from our side, City Falcon. And one interesting feature that we have is the advanced search, where you can combine two things. You can put this or that, this and that. So if, for example, you want to have everything that is related about this situation, and you want to track all articles in different places for different periods, you can do that, and then you can have a news grouped or go with filters for specific options, which is cool when you're searching in a situation like this one. Now, all this situation creates implication, and we know already. Do you know what happened? Because we already had the announcement of the Fed decision. Do you know what happened? Did anybody quickly search earlier? I think they increased 25. Yeah. So basically, there were thoughts that because of this situation, maybe Fed would put inflation, the fight of inflation, second, and will say we're not increasing more the rates. But it seems that they want to fight the inflation, and they can accept that the situation could evolve. Maybe they think that there were some failures and we are not in a situation similar to 2008. It seems probably from their decision. But since we are here for the interest rates, or does anybody want to comment about what they think? Do you think that this now is a pause, or because we saw this graph, and if anyone has an opinion about the rates or the inflation, you can quickly say your opinion.
That's all I wanted to say.
Okay. And basically, if the underlying, in the underlying inflation, when they count it like month by month, it's low. So basically, when you have an interest rate which is above the inflation, basically it's restrictive. The real interest rate is, and we are now somewhere that the real interest rate start becoming negative and restrictive for the economy, and that might help the inflation go down further. Also, now something again that's an interesting insight that comes from our tools and from the sentiment tool. Here we count the sentiment of the fintech sector industry, and it's interesting that by the time that we had those events and banks collapsing, the whole sentiment for the fintech sector is becoming negative, which shows that investors and the press they are more cautious towards fintech. They see them in a different way because of all this situation. Anything to comment here, Ruzbeh, or anybody?
I think it goes back to kind of, I mean, how many people have a Revolut account here? Revolut bank account, right? Now, did you guys do anything when SVB happened? Did you think about your balance there? Revolut? They hold the money? No, 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 no. No, no, I'm just saying in general, because as a fintech, sorry? A contagion, and like fintech banks which are very aggressive, they're into crypto. So yeah, but that's even worse, right? With your money. Yeah, what I mean is it's not a traditional bank. It's more a risk-taking bank like SVB is. Um, so yes. I mean, Revolut, if you look at it, like very heavy, like getting into crypto and other things. I know they can. I know. I'm just saying it's one of, yeah, but I'm just saying that it's what seems to be happening with the trend is that uh, at least a few people are thinking about it, where the money is. I would want to be conservative and put in one of the high street banks, which doesn't, Credit Suisse was one of them, but it just puts a mind, or at least diversify, open multiple accounts, spread it out. Yeah. Ah, s- but it depends, right? So, for example, we have a Revolut business account. And the reason we had to open a Revolut business account was so we operate in London and Malta. In Malta, we couldn't open a high street account. So we had to open a Revolut account. But you're right in terms of restricting the amount of money. But that goes back to, again, if you have trust in this bank, why don't you put more money? Yeah, that's the point. So at different jurisdictions. Yeah, different licenses.
Yeah. So in the UK, you use SEB. In Europe, they have a banking license in Lithuania, and they are a bank. your friend like basically passed the solar one of the meetings, giving accelerate the vehicle lights.
You cannot see your line, but we can pass it to whoever talks. Yeah. I mean,
Sorry, I'm talking too much, but there's a story that I mean, it's true. Like, so basically, the guy who started is Russian, right? And they applied for a banking license in the UK a long time ago. It's been kind of the bit of foot dragging, and there's a story of him kind of literally like salting Sunak in one of the shindigs they were together about, hey dude, why don't I have a banking license yet? So they don't have a bank license in the UK, but they had one in Lithuania for a while, and they use SVB like infrastructure here. I know this because at some point I transferred some money and they had to reverse it, and I had to go through many emails and calls of different branches and places of SEB in the UK in order to get my money back, because it doesn't matter what, but yeah, so exactly. So, but I mean, yeah. So Revolut is a joke. I mean, it's not really a bank. Like it's just so yeah.
Sorry, just coming away from Revolut and back to the original point, SVB, what was one of its major downfalls? It was holding and essentially taking a view on long dated treasuries, right? It should never have been doing that. What we're saying is a more traditional bank should have stricter risk controls in place and therefore not be making money on the side, like essentially running, a prop desk on the side, which perhaps is what was happening here. So I've lost my point, but I think that was the main thing here, which is I'm talking about contagion. Yes, someone like Revolut, maybe less risk control than your traditional high street bank, and therefore do we see a flight to quality in the financial sector?
To your point, actually, what SVB did was so beautiful. It's not only that they not have the risk controls, as you beautifully said, they were focusing on accounting profits and loss without mark-to-market profits or loss. So they were actively selling away from cash, and they were actively getting rid of variable exposure in the assets to make sure that it's fixed. But they didn't want to see variability in the accounting numbers. They just want to make sure that, but obviously in the live world of rising interest rate, that means you get destroyed. Yes. So it's not that they were bad at risk management. They were actively going against what a good risk management system should be.
Here, please, and then we have Sanjiv, and then.
Sorry. What's where the interest rates have been so low for so long, they've had to sort of jump into certain bonds. And I just think what's going to happen is as the rate starts increasing, you're just going to get blow-ups left, right, and centre. I think there was the insurance blow-up earlier this year when last year. And so that I just think what's going to happen is as interest rates start creeping up, you are just going to see all these institutions, financial institutions who've done this sort of stuff, just start blowing up left, right, and centre. Because there's no way out of it, and they thought the safe option was interest rates are going to be low forever. But and then I think that's what's going to happen.
Exactly. I agree with what you just said. But on SVB, it was a unique set of circumstances. Firstly, as we discussed, their deposits were very concentrated. And on the asset side, half the $220 billion balance sheet, 100 billion was in bonds, a very large percentage. But they were treasuries or mortgage-backed securities. So what the regulators do is they charge you capital for all your assets. And they risk weight them. And they say sovereign bonds of major countries are zero risk weighted. So you don't essentially need any capital for holding gilts or UK treasuries. So of course bank load up on them, providing they meet their other requirements. And mortgage-backed securities only have a 20% risk weight. But corporate loans have 100% risk weight. So if SVB sold some mortgage-backed securities and put some loans on the book instead to one of your startups, they would have to have 5 times as much capital, regulatory capital, backing that. So the regulatory system encouraged them to do a barbell strategy, put half the balance sheet in what were low risk assets, mortgage-backed securities bond, and put the rest into Silicon Valley type companies. Unfortunately, the one which was very risky carried on, but the one which was thought to be low risk blew up because of the market movements last year.
Sorry. Please repeat.
Yeah, I'm saying that asset liability management functions in a bank. That's one of their basic principles, right? If half of the book is in bonds, then very evident there has to be a foresight that what's our hedging strategy in case interest rates.
Right? We all analyze companies, all of us, to some extent. We have maybe 10, 20, 30, 100, whatever company that we look at, analyze. How many of you were completely shocked that some of the companies you never thought possible had exposure to SVB? Really, nothing. No, not affected. But did you realize this company that you thought does completely like a wine company, Naked Wines, was exposed. Moonpig, which does greeting cards, was exposed. I mean, but I mean, why would a company that sells greeting cards have so my question is, like, okay, I'm the only one, apparently, but they didn't blow up. They had exposure. They actually had some loans or cash with SVB.
Profile of Moonpig, it's a really successful, quite recent IPO. It's a startup. And SVB has marketed heavily to take that sort of company deposit. So why would you be surprised? Because it would actually fit the profile of an SVB client.
What about Naked Wines?
Again.
It's a startup. Well, not a startup.
But
it's that sort of concept of
well, it's probably a 25-year-old, I don't know, 20-year-old business, and SVB is a 40-year-old bank.
And actually, if you're a startup, if you were going to set up a business, I think you'd go to SVB straight away. Sorry. Okay. Yeah, oh, that's what I was going to say.
Of course,
I think you're.
This one is the last one, and then we can, at the end, when we finish the presentation, we can talk anyways and say more.
So all I was going to say is, I think if you were going to start, if you're going to set up a startup, you'd want to hedge for the best opportunities. And SVB was a company or a bank that just understood your business models, and they were they were in a position where you could make a loss for the next 5 years or 10 years, and they'd overlook it because they knew they understood your business model. Whereas you can go to NatWest to do the same. So it doesn't surprise me whatsoever.
So this type of interaction is what we love, but because we have a few more things, we want this type of discussion to continue in every aspect. That's why we are, So now this is a discussion that we can have. Who you think is gonna be the next? Do you think that this will spill over and affect more and even go to a major crisis, or is it something that it will be contained? And who you think it's next? And that's a good discussion that we can do the same way. So you can participate the same way.
No, only kidding.
Like any or things that you suspect that might fall.
What I find interesting is how the central banks have reacted this time compared to what happened with Lehman. So I think they are moving quite fast, and which is quite good to see. And there was a lot of focus also to keep mentioning that they're not using taxpayers' money. So they're trying to find these deals. So I think those have been quite positive on how they've managed it.
Yeah, if I will have to make my bet, it will be one of these funds that holds a lot of illiquid assets such as real estate and then operates liquidly. And I think there have already been some funds of real estate that had withdrawals halted because of this.
Not just the banks, but a lot of startup funding can dry, like what they say, the risky capital from the market, which was like unlimited liquidity for past 10 years, that can definitely slow down and
We are in the process of raising VC money. So I'm meeting VCs quite regularly, and it's a big shift in how, and I think it's the right way of looking at investment. So there was this FOMO before, that if you didn't invest your money, if you didn't deploy your capital, and that's why the valuations went up. There was a lot of money, there's a lot of liquidity, but now it's dried out. Businesses are failing, people are losing jobs. They might, I mean, VCs themselves, it's the strangest thing I find is that on LinkedIn, I'm trying to raise money from VCs, and then VCs are pinging me to raise money from me. So like the general partners are looking for limited partners to fund their VCs. So it's definitely happening, and I think it's generally been, I think, positive for the community, like the startup community, because people are more sensible about how they use the capital, how, even like the salaries, which had gone crazy in the tech world, when we're looking to employ people, and we've seen like people like salaries coming down like 20-30%. And when we put out a job post, I was mentioning earlier that we put out a job post for a developer 2 days back, and we got like 200 applicants in no time. And quite a lot of them are actually decent. So we're going to interview, maybe hire 2 instead of 1. So yeah, that is definitely happening.
Appreciate startups that they are more conservative, they are cost sensitive, they have some revenue, they don't go so aggressively.
Yeah, I mean, the one downside though is that I think for companies that are raising money, it's not only the valuation that's going to be brought down, but it's also other factors. So VCs want to limit the downside in terms of whether it's an anti-dilution clause or like things like liquidation preferences, all of those things coming. Yeah.
While we are here, I thought we're all value investors, and value investors believe in things like cash flow and profits and tangible, ongoing businesses. So, if we are value investors and we think of like value investors, why are you surprised that all of a sudden VCs starting to really acknowledge that there is a lot of value in value thinking, that I'm going to invest in a company which actually makes money?
I mean, it's you can't be a value investor and invest in startups and early stage company. It's very difficult. But much later in a stage, like early on, it's difficult. Anyway. Yes. Yeah. I guess the challenge for us as value investors is also that there's a lot more research to be done than just what we've done in the past, like including now where they're keeping their money, where are the investments sitting. So it's more work for us, but I think also more opportunities through this. Yeah. We need 2 mics.
I mean, what I see from this is who is next? Is there going to be a next one? Well, it doesn't matter. What we're seeing is this is the end of the bubble, right? The bubble's finished. This is a readjustment period. Companies will fail, not just banks, but we're going to see a lot of companies going, not a lot, but we're going to see companies failing, and a complete, maybe not complete, but perhaps a serious readjustment in valuations. And that's no bad thing, because as you described the VC world, it was a complete bubble. The valuations made no sense at all, and that was stoking up the listed markets as well. So it's a readjustment period which does throw up a lot of opportunities for value investors that can kind of see through it and look a bit longer term.
Just to agree with that, and put a little theoretical framework around what you said, is whenever, for example, basically for 10 years, a decade, essentially money interest rates were zero. So people got used to the idea of capital not having a cost. And so all kinds of financial structures, leverage structures were built up. on that assumption and on the assumption that that would carry on. Now, clearly, capital has a cost, and a lot of things which were investments which were made then have to be liquidated. And in a sense, the next recovery can't happen until people recognize they've made a mistake and they liquidate that. So there's a kind of Austrian economic framework which talks about the business cycle and the credit cycle like this. And the very nice word they use, which is called malinvestment. Mal as in malady, sickness, and investment. So sick investment. And it's just that people are going to have to realize that the assumptions they made when they made these investments no longer hold, and they're going to have to write them off. Banks are going to have to do a lot of write-offs. And until all that happens, the recovery, the economic recovery, I'm not talking about stock market recovery, can't happen.
But I think there's a lot of because of the interest rates and free money, they've just survived for decades, and so over the next year, I think as interest rates creep up, and it seems as if the intention is for interest rates to continue to creep up, to sort of blow up these sort of companies, and I think it's a good thing because it needs to you almost want to clean and have a clean slate and then start again. Because some of these guys are just basically just borrowing money, and there's no profit, and they haven't made a profit in years.
Sorry. Then Alex is you. Okay. Sorry, Alex hasn't talked, but if you have.
No. Just to agree briefly what you said, it's not that these write-offs must happen, but they have to happen. People have to recognize and write them off.
Sorry, Alex. You haven't talked much.
Yeah, I haven't talked much tonight.
A lot of growth, a lot of
No, I don't really know much about this stuff, so I've kept quiet and I've listened. So as a deep value investor, I'd say rising interest rates are good for me because the discount rate's higher, so therefore valuations are generally lower. But at the same time, if the company has lots of cash, before it was earning nothing in interest, but now it's earning a multiple of what it was earning. So, value investors have had a tough time over the last decade, but maybe in the near future, it'll be our time to shine. So that's what I have to say.
But is anyone buying financials?
The CEO was just banging on about the in-house rate. In fact, he was saying because they obviously sort of.
Can you please repeat?
So I'm just trying to rack my brain as to which company it was, but this company basically it's a payment company, and they had a bunch of money, a huge pot of money, and he was really excited about the fact that the interest rates were just going up, and he was saying, well, we are making now a huge profit just from the interest, from the balance of our cash sitting in the bank. So as you said, it sort of turned the table in a lot of ways.
Look, we can finish this type of conversation, and okay, one more, and then we have one.
So I'm actually gonna pick up on two things that you guys said, which I thought were very interesting. Maybe I can add something. So to your point about companies being cleaned out, so we all understand that if interest rates go up, valuations come down. So valuations coming down of growth stocks, especially. But then there's this distinction between growth stocks, which have impaired business models during times of higher rates, like Klarna or whatever. And there are other companies who had high valuations who actually are very valuable businesses, let's say like Datadog, for instance. Right. So the distinction that has to be made about impact of higher interest rates on the growth sector, because it's not there are two buckets here, and we have to think really hard which bucket are our investments in. So that's kind of what I would come to your point. So your point is that you kind of admitted that value investing has additional macroeconomic risks. It's an interest rate risk. There are others actually, but the point is, although the market moves up and down, and value stocks move up and down with it in a different way, there's a second, let's say, we call it orthogonal factor, which are interest rates, which determine risk, let's say, attractiveness of value companies. So Finance theory will tell you if you're a company with additional risk, it should be valued lower and should have over time higher returns. But it's not free lunch. Because when you invest in value companies, you expose yourself to said interest rate risk. So you are getting compensated for the risk, but it's not something like irrationality of markets or some amazing insight that you had. It's part of the usual grind of macroeconomy impacting stock market. It's just value companies have an additional vector or whatever they want to call it or aspect of risk vis-a-vis normal companies.
Thank you. Yeah. So I'll just show a last thing. We can continue the conversation after this when we close the official part. And this is one of the benefits of the people that they come in person. The rest online, we thank them, but they can feel jealous about it. So they should also try to come here. Yep. I will quickly try to say that I don't bet in anything because the banks are very unpredictable, and like 10% is equity, and so it's like a small buffer. They're like options. So if something is in the representation, like a small deviation, a 5% deviation, is all or nothing. It's like maybe 50% of the book value. So I avoid, because also I'm not a financial expert. Somebody who works in a bank, maybe he can calculate. And again, when you have this little margin like an option, it's quite. But yeah, so I wouldn't bet on anything. But thanks for the question. But I have an answer. Sorry, I have an answer, and we can continue later the conversation. Okay. This is not mine, but if we expect a similar, because sometimes a domino can go in ways that we don't expect. But if we expect like a similar type of domino, something interesting was somebody who has a YouTube channel, opportunistic trades. He made something which it's interesting. You cannot see it later. You can see it on the presentation on the site, right? So here it shows the banks that if you calculate the hold to maturity losses that they haven't been presented yet on their accounts, it might be like 3 times their equity or 2 times their equity. So here there are some banks. I don't want to say the names. I don't want to spur panic. That's why I have made it. So don't take them as it's just an opinion. It's not any big investor. It's something on Reddit interesting that I found. And the other one, again, okay, now they have said that they will secure all deposits. But again, the idea of panic is again on what percentage of the deposits are unsecured, like more than 250,000, like them. So this can be food for thought, and we can continue now the discussion offline. Ruzbeh, if you want to say anything last to the people, we just thank you everybody. Thank you.